Ladies and gentlemen, distinguished guests, dear Nicholas, thank you very much for the kind invitation and organization of yet again another remarkable event. It's really a great pleasure to be among so many distinguished guests and especially the members of my fellow panel, which kindly allow me to introduce. On the left, Mr. Giovanni Capello, Chief Financial Officer of d'Amico Dry, Mr. Dimitris Glynos, Vice President Finance of Dryships, Cardiff and TMS, Mr. Pankaj Khana, CEO of Pioneer Marine, Mr. Vikram Hiranandani, Director of Corporate Finance on Scorpio Tankers and Scorpio Bulkers, and Mr. Christos Begleris, Co-Chief Financial Officer, Star Bulk Carriers. In a business environment where traditional ship finance seems to be following a deleveraging or exit strategy due to the well-known stringent capital regulations, the ongoing legacy portfolio losses and strict single name concentration limits for existing clients, we witnessed the reappearance of strong interest in shipping from equity and bond debt market for the global shipping company, but most crucially for an increase in appetite for new shipping transactions from the Chinese leasing companies. And I would like to discuss a number of critical points with my fellow panelists. Dear Pankaj, from your perspective, how do you assess the traditional ship finance versus leasing options in the market these days?
So Pioneer is a medium-sized dry bulk company. We operate 16 handy-sized bulk carriers. So for a company like mine, the easiest access we have is to obviously the traditional bank finance. So when we started this company about 4 years ago, we actually bought all our ships with equity and then eventually financed all of those with bank debt. So currently I have about 100 million of debt outstanding. It's only about 1.5 million of net debt per vessel. That is of course still the cheapest source of financing in this market. But of course over the last 10 years I would say bank financing has changed. The regulatory environment has changed, and as a result of which bank financing, although still the cheapest source, is a diminishing source. So we don't have as much liquidity as we had in prior years. And then of course the banks now want to lend to large corporates rather than to smaller companies. So the toolkit for a shipping company has to be expanded, which means that we need to look at every financing available in the market, which means whether that is the leasing from Chinese banks or term loan Bs from the US market or Norwegian bonds. So in essence, we're looking at all the options at this point in time because that's what you have to do today.
Definitely, it's all about the options these days, and it's definitely a dialogue to be had. Vic?
And if I may add, Scorpio Bulkers and Scorpio Tankers, between the two companies, there is $4 billion of assets. And we need to have a very diversified source of capital to finance these assets, which we do. We have around $2.5 billion of debt between the two companies. $2 billion is the traditional bank and ECA financing. And then even we tapped into some retail bonds in the US. We've always been looking into Norwegian bonds as well, but we have done the US retail bonds. The financial covenants are quite flexible and light, and it's an attractive source of capital for the company. And even we have done converts at Scorpio Tankers to help us finance our humongous order book, most of which has been delivered and is on the water. So I think it's very important to diversify your capital sources. And most recently, we did a sale-leaseback transaction as well, but that's an operating lease structure. But it's all about diversifying your capital sources in an environment when you see bank financing getting restrained. It's still available, it's out there, but banks are becoming more selective, and as a major ship owner, we have to be committed to diversifying our sources of capital.
Vic, from your experience on your recent discussions on leasing, which assets do leasing companies seem to be interested more these days? Is it fair to say that, let's say, that strong interest has re-emerged on bulk carriers as well?
Yes, we have spoken to some of the major Chinese leasing companies this week, and we've been in touch with them for several months. And with dry bulk going through a gradual recovery, it's actually quite significant over the last 6 months. The entire environment has changed on dry bulk, and banks have been, even traditional sources of capital like your bank financing, have been open up to having discussions on dry bulk. But the Chinese lessors are also keen in exploring transactions. A company that has access to capital markets, they look at more on a corporate strength. There's usually a guarantor from the parent company, and if they are like with Chinese leasing, though, it could be a little bit more expensive, and the break-even rates might not work completely. But if there is liquidity on the top, the Chinese leasing companies would be interested in having a discussion. But I think they would be a little bit more conservative on leverage on dry bulk versus product tankers for now, but that could slowly change.
Yeah. Giovanni, from your point of view, have you been approached by Chinese leasing companies, and do you think that your business model fits their projects and their profile?
Thank you, Nick. For our perspective, we in the dry side of d'Amico have a fleet size in the region of 50 ships, of which 25 owned. Right now, up to now, we use the usual source of financing, traditional loan with banks, mainly European banks, but also Asian banks, Chinese and Japanese banks. Regarding to the finance lease, we are discussing, and we think that the key point there is, as Vic was saying, to diversify the source of capital. And I think that this model could fit, even if the pricing would be higher than the traditional financing, in the sense that the leverage could be better in this moment in which the market is going better but still running at a soft level. So could be good to have a trade-off between the pricing and the leverage, and to explore more forward.
Thank you very much. Christos, Ocean Bulk was the first international client of CCC Leasing, and also been recorded that you've done exactly with Ocean Bulk container ships with CMB. So your views will be very important in terms of the terms offered. Do we really consider they're appealing for a global player these days, especially on the capital-intensive project like a big new building project or a big balloon refinancing? How do you see the terms offered?
Sure. So we have invested in relationships with China quite early on. I have been dealing with the Export-Import Bank of China since 2008. Back in 2012, we did bilateral deals with China Exim, and then struck quite a few deals with leasing houses, including CSSC, including CMB, including BOCOM, including also directly with leasing subsidiaries of shipyards. So leasing financing has been extremely important to us. We have now raised close to $1 billion of Chinese financing, both with China Exim as well as with leasing houses. And the experience has been extremely positive in that we have placed orders on the back of also financing deals that we had with leasing companies. The terms have been quite attractive in that, for example, leverage was at a fixed price to the contract price. Therefore, we did not experience what other companies experienced when asset valuations went down. We did not have to come up with more equity at Starbulk, which was very important. And also on the covenant side, the leasing houses have been extremely flexible, which again for a public group, it's very important. I have to say I disagree with Vic in that the availability of leasing financing for dry bulk for companies that have had strong relationships has never really closed. So 2015, 2016, our partners were there for us, and that's very important. So I consider establishing relationships early on, going also through the bad markets, seeing flexibility from them, and then as the recovery comes about, them being again open to do new business has been very crucial for Starbulk. Now, as far as the terms are concerned, we are seeing margins coming slightly off compared to the levels that we saw in 2013 and 2014. I think that now is a great time for Chinese leasing corporations to go out and lend, because as Giovanni said, valuations are lower. Therefore, the leverage that the leasing firms provide compared to historical averages is much lower than what was offered back in 2014. And covenants are still much more flexible than what is being offered by the traditional Western shipping banks.
Thank you very much, Christos. Following up from Christos' comments, Pankaj, would you think that high financing leverage and pre-delivery finance are still the main key benefits on your agenda, versus the alternative financing?
Well, I think my friends over here on the left both talked about mostly on the new building side, at least from what Starbulk has experienced. The time taken by the Chinese leasing companies, or in general for Chinese financing, is a handicap, especially in today's dry bulk market, where the most lucrative deal is a second-hand ship. I do not want to do new buildings. I would rather go out and buy second-hand ships, which I can get right now in trade. So, in that sense, taking a minimum of 3 months, maybe up to 6-8 months to do a deal, to do a leasing deal is tough. So I have to have very deep pockets to go out and do the deal with equity, and then later on put the financing on. So I think what Scorpio has done in terms of sale leasebacks, where it's a more defensive play, it's something that frees up your equity and helps you ride out a tough market. In that sense, the high leverage and the ability to do that deal is advantageous. But in general, of course, if I look at leasing, it is more expensive than traditional financing. So the most key feature for that is the higher leverage and the fact that I can free up some cash from my balance sheet. And then it depends on what the use is. For Scorpio tankers, it was more defensive. For someone like me, it could be more offensive. If I believe that the market is going up and I want to go out and buy more assets, this allows me to free up some equity capital to go out and do that.
If I may add, Nick, there is another benefit that has become very evident to us that comes about with working with Chinese leasing firms. It's not all about high leverage or pre-delivery financing. It's effectively having a real partner when you place an order. So given the lessor-lessee in the financial lease structure, essentially when the market turned sour back in 2015, it was very beneficial to us that we had Chinese partners, financing partners in our vessels involved early on from the contract signing date, because we were able to go together back to the shipyards and push back the various vessels or try to improve various terms of the new building contract. I don't think we would have been able to do so well if we didn't have with us our Chinese partners, because it's a different thing for a Western, although with a long history, a shipping player talking with Chinese shipyards. When you have a Chinese partner by your side, it's a whole different story.
It's fair to say that it's a strategic partnership. From our experience with Smarine so many years, we've seen that actually it makes sense. You unlock a completely new world and a new tab of financing, and definitely strategic makes sense to go forward with it. And we've also seen pricing come off, definitely. And we started seeing and converging towards more traditional sea finance. And this is something that I'd like also to touch with and reflect with Dimitris, whether he sees a trend towards, let's say, terms, reflecting more traditional sea finance rather than, what we used to know as Chinese sea finance leasing.
Well, from our side, we've been again traveling to China since 2008, and even since 2013, we've been starting meeting with the leasing companies. And although we have not done any business with them, we believe they're doing an excellent job as they're helping, various ship owners that they're on their needs basically. So from us, from the economic group, up to now, we have not been able, let's say, to do a deal with a leasing company because of slight or some difference in pricing. As Vikram said, we can still find competitive financing in the banks market. However, from my discussions of the last few days, it seems that Chinese leasing companies can come these days more competitive than in the past in pricing, and from my side, I think it would be very important to see them diversify a little bit in the products they offer, because for some ship owners, traditional financing is the optimized way to do this. So if the Chinese companies, they both offer the high leverage and a bit higher pricing, but if they also, provide the second option, which is closer to the traditional ship financing, this may also have a lot of demand from various traditional ship owners. Having said that, even with the current terms, it's very important, as everybody has said in the panel, to diversify your sources of funding. That's why we actively, visit China every now and then, to try and find common grounds to do a win-win project.
Nick, if I may add again, actually they've moved. Chinese leasing corporations are changing their business model. They have tried to differentiate in the past with 80% plus financing, with a margin starting with a 4. I was actually quite pleased that this year we're talking about 60% loan to value, with a margin that is extremely close or even more competitive than what we see from our Western shipping financing banks. So they've realized that there is a definite gap with all the German banks, maybe with the exception of DVB, not being active in the market, with all the French banks, with very few exceptions, not being active in the market, with all the Scandinavian banks effectively having their own problems because of the offshore exposure. So they've actually moved from an 80% plus financing model. They're now also moving to the 60% plus with a very competitive margin. And this is, I think, a very positive evolution.
Thank you very much, Christos, for that. I think another positive evolution that we've seen in the market is about the perceived condition precedent of time charter. These days seems that we have evolved that it's now a preference rather than a necessity. Would you like to comment on that from your experience? Vic?
Yes. So, first I would like to say that on top of the Chinese leasing companies, even there are certain banks that can offer very competitive proposals if you have a time charter attached to it. And they try to be, pretty much as competitive as the leasing in terms of aggressiveness on the leverage for a deal that is backed by a time charter contract. We did a 3-year time charter contract for Scorpio tankers. It was a very short time charter contract, and we had one of the Canadian banks to offer financing at LIBOR plus 150, which is very competitive. But there are certainly benefits if there is a time charter contract. In regards to contracts of affreightment, it helps a little bit, but it's not as strong as time charter contract. And Our vessels for both bulkers and tankers predominantly are operated in Scorpio pools, and so it's essentially all spot exposure. We like that model. It allows us to leverage against market pickups. And for that, when we have discussions with leasing house, it all becomes all about like the corporate position of the company and the balance sheet and the capitalization of the company. But essentially, I would say time charter contract can get you much better terms. But you could even have a good discussion if the company can demonstrate that there's good access to the capital markets. There is a lot of value in that as well.
Thank you very much, Vic. Giovanni, from your point of view and reflecting on the comments on the previous panel where, contract of affreightment has also been referred as a ways of unlock, let's say, interest and better terms from Chinese leasing finance. Would a group of your size and, let's say, characteristics be prepared to follow this route?
Yeah, I think this is an important point to be highlighted because for our company, this is a strategy. We have as well a pool for the Supramax segment as Scorpio has for trading the spot market. But for one segment in particular, which is the open hatch box shaped, we work a lot through COAs. This segment is more industrial than other shipping segments like Kamsarmax on Cape and Supra. So with less volatility in, the important thing is to build a long-term relationship, which we are doing, right? And to have always a certain part of the fleet covered through these COAs. I think that this could be considering this part of our fleet as a unique fleet trading the same market would be a value added to this kind of transaction because can offset the peak of the market and can guarantee, let's say, 50-60% of the revenues already done. So I think in this market condition could be definitely a plus.
Thank you very much, Giovanni. Dimitri, can we also reflect your thoughts on this one, please? Would be an interesting proposition to combine a contract of affreightment.
Yes, no, certainly. It always helps to have the full deal in place. So essentially, here is a great job that also you guys are doing. As brokers, and you've been very helpful in bringing deals together. So yes, this is something that can definitely work.
Do you think also that there is a better understanding in terms of accelerated deal completion timeline? Have you seen, let's say, some improvement in that sense?
Well, I will let my colleagues comment who have actually done deals with leasing companies.
Christos?
So we've been lucky because our Chinese partners have been relatively fast from the time that we have agreed on a certain transaction. We moved fast with the documentation. I think the fact that we have used Western lawyer offices, both from the Chinese leasing side as well as from our side, has also sped up the whole process. But definitely there has been a huge education curve for the Chinese leasing houses, and they're now much better equipped to adapt to the needs of their shipping clients. As Pankaj said, it's extremely important that the timeline to close a transaction converges to what we have been used to with Western shipping banks. Although, if I may add, Western shipping banks these days, the credit committees are pretty tough. So the Western shipping banks process is taking more time. The Chinese leasing firms are actually reducing the time to close the transaction. So there is a convergence which helps.
Scorpio has closed only one sale-leaseback transaction, which is with Bank of Communications. And similar to Christos, we had a very positive and pleasant experience in regards to the timeline. It was very quick. 3 to 4 months, we went from start to finish, so we were quite happy with the timeline. And if, we were to do another transaction whenever, we think that we could even build upon and have it more accelerated when you become a seasoned player in that market. So it was quite impressive, the timeline.
Can I add? So the first time I dealt with Chinese financing was back in 2006 when at TK we did a couple of Suezmaxes, and it took us 6 to 8 months to close that deal. Then when I was at Dryships with Dimitris, it took us 18 months chasing one of the banks over here, I will not name it, for a VLCC financing, and we were still unable to close it. I have done on my fleet a Sinosure financing with Western banks, but with Sinosure cover, and that took us around 8 months to close. So it's not easy. What he's describing, 3 months and so on for sale leasebacks, etc., sounds very encouraging. But in general, I think that's the biggest handicap that the leasing companies and Chinese financing in general has. If we can converge down to 3 months, I think that's a big advantage, because then it blows out the traditional banks, which today normally take about 3 months to do a deal.
And just to add on Pankaj, it's true that our first deal with a Chinese institution, it took a long time. And having said that, the second deal that we did, we saw the economies of scale in, achieving, much lower timing. However, that was still a bit far from the 3 months, so I would say it would be about 6. But you still see the difference from the first to the second deal, and we feel that Chinese institutions are getting better in their timelines. So ideally, it would be the best thing to reach the 3 months period, as Pankaj mentioned.
Yeah, I can confirm as well. We did one transaction in China with the Chinese financial institution, and as well it took us more than 12 months. And so in that sense, the timeline focus is very, very important, because we are used to dealing with European banks to a smoother process and with the shorter timing. So.
I think so, one of the things that have evolved over the years, we've seen some initial deals that were really pioneering deals in the segment, so it took months. And but then again, when the institutions are becoming more and more familiar with both the segments and the counterparties, we've seen from our experience with Smarine that the next deal is much better, both in terms of timeline as well as pricing. For example, it's been pretty interesting for us to see that even about 3-4 months before, there was no interest for bulk shipping. Now there's definitely interest on bulk carriers. The LTV is coming closer to the ones with the traditional finance, as well as the pricing. So there seems to be a hot topic, it's evolving. And we've also seen a great number of new players coming into the market. So I wonder whether this will create a cascading event that Chinese finance leasing will be headed also towards the medium-sized groups. How do you see, let's say, this dynamic market coming, Giovanni? Would you think that these new players will bring something much more competitive in terms of timeline and pricing?
Hopefully not on new buildings. No, I think so. I think so. It's always a matter of experience and economy of experience on top of scale. So enlarging the competitors panel would of course help to shorten the process. I think as my colleagues were saying, this is always has already happened and is ongoing. I believe that this will be definitely a window of opportunity for Chinese leasing company. Having said that, through the Western banks, some of them have a problem of portfolio, of leverage, the Basel III, and so in that sense, we have seen some banks going out from shipping after the previous years. So I think there will be a window in which we find a solution.
Reflecting on Christos' earlier comments, I have to also admit that funding for the right group, even on dry bulk shipping, has never stopped throughout the years. I mean, for the right owner and for the right project, funding was always there. The thing is that we've seen that each bank has its own single name concentration limit. So we've seen big projects that could be done, let's say, with one bank in the past, now that you have to go down the route of syndication or a club deal, etc. So I think this is where Chinese sea finance leasing has come to bring along the fruits of, big exposure, big numbers that cannot be accommodated by European banks these days. As Christos said, have a strategic partnership for big numbers going forward. However, what if we could combine the two, Christos and Vikram in particular? Do you see any benefit in using your traditional ship finance lenders, which I presume are mostly banks, from Europe and Americas, in discussing with them possibility of co-arranging with a Chinese leasing company, lease finance, by way of back funding the Chinese leasing companies? I mean, would you deem this to be beneficial for your group?
If I may start, I would prefer to keep them separate. We have very good relationships with Western shipping banks, and they've had a traditional model of doing financing at 50 to 60% at a low cost. So there are projects where this type of financing is appropriate, and therefore I would prefer to deal directly with the banks and not have to go through a Chinese leasing firm in order to complete a project. Now there are other projects that, for example, higher percentage of financing is more appropriate, or the pricing is as competitive as the Western shipping finance with lower leverage. Therefore, I prefer to deal separately, again, with the Chinese leasing institutions. There are strengths and weaknesses in dealing with both. Therefore, I would prefer not to have to rely on the credit of a Western shipping bank to do a deal with a Chinese leasing firm.
What if they were funding the Chinese leasing company, raising a bond for the Chinese leasing company, so giving you the benefit of the deep, intimate knowledge of your group, so actually coming as an ally and making the Chinese shipping finance company feeling more comfortable about the risk they are taking, so really just transferring the benefit of the improved pricing to the group?
If this is in terms of transferring and improved pricing, as you say, then obviously this is positive. However, the way that Chinese leasing financing has traditionally worked is that Chinese leasing has a specific deal with us. Let's say it's a high leverage transaction of around 80%. Then the Chinese leasing house is going out in the market to find financing from the traditional shipping banks in China at, let's say, 70% leverage, and then they use their own equity for this 10% that remains to be funded in a transaction. Now, if a pre-packaged deal with this shipping bank basically means improved financing terms for us, then we would definitely be open to it. We haven't seen the benefits yet.
Can I offer a different opinion? I have 3 of my bankers in this room who intimately know me and the company. If I want to do Chinese leasing, I think I could very easily go to those 3 guys, and they have relationships over here which are deeper than my relationships with the Chinese leasing companies, and that would be a win-win situation for both the leasing company and for the European banks I work with. So I don't think it's a yay or a nay, it depends on the situation. So for a medium-sized company like me, it may be an advantage.
Exactly. It's a hybrid solution that could work and expand the benefits to more groups going forward. I'm happy to take questions from the audience. No? Okay. And that concludes... Oh, sorry. Apologies.
I would like to ask my question in Chinese. Most here are Chinese. 我有一个问题问 Mr. Christos Begleris. Just now, oh sorry. 刚才您说，就是你从中国的 leasing 公司拿到的这个利率大概是8%，我想能知道一下，您现在这个运营你们公司的那个船队的利润率大概是多少？谢谢。
I wish I could reply directly, but we haven't learned Chinese yet. It's in the projects, though. We'll get there. So what was the question?
There's a translator.
Okay. Sorry.
Okay. My question is, just now you said that you got some leasing cost around 8% from China leasing company. So may I know how about your profit rate?
Mine?
Yeah. How about your company's profit rate?
What do you mean, profit?
You operate your ships, you're running your ships.
Our preferred rate.
Profit rate, yeah. Compare with your financing rate.
I mean, this year we've seen everything actually. In that, some Chinese leasing companies have come very close or even more competitive with the rates that we get from Western shipping banks with lower leverage. So this is an important evolution for Chinese leasing financing, because they have understood that there is a clear void in the market, and they've come to feel sort of the same profile as the Western shipping banks. So obviously the lower the cost, the better for us. We understand that there is a risk management process also from the leasing firms. They need to make a profit on the equity that they place. Now, if they're able, like they have been in the last year, to raise bonds at a much lower cost than what they were achieving in the past, the fact that they're transferring some of this gain from the lower cost in the bond markets that they get to us is beneficial.
Thank you.
I think Christos very much recapped the evolution we've seen during the last 12 months in the space. I'm pretty happy to witness the fact that Chinese leasing companies have become much more flexible. Pricing is coming down, interest has increased, definitely for many more groups that are not necessarily public or household names in terms of private family names. And as we said, pricing is coming down and new players coming in. I think that's a very positive note going forward. I think with the right tweaks and just a bit, some credit demands become a bit more, let's say, friendly, we're probably witnessing the converging of Chinese finance leasing towards traditional finance. And then we'll probably not be speaking about an alternative means of finance, but actually an established traditional way going forward. Gentlemen, thank you very much for your constructive approach and dialogue. Ladies and gentlemen, thank you very much. That completes our discussion.
Thank you.
Thank you.